Under ASC 842, the lease liability that's recorded is calculated by taking your remaining lease payments and discounting those payments to a present value. The discount rate that you apply is a critical component, and it is important to accurately determine this rate for your leases because it directly impacts the amount of your lease liability and related right-of-use asset on your balance sheet. Hi, I'm Priya Singleton, Quality Control Officer at Blue & Company, and I'm going to walk you through how to determine the discount rate to apply to your lease contracts. The new lease standard requires lessees to use the rate implicit or implied in the lease, but oftentimes there's not enough information available to you as the lessee to determine the implied rate. You may not even know the estimated residual value of the leased asset or the initial direct cost incurred by the lessor. The standards acknowledge this issue and thus have stated that the lessees use the incremental borrowing rate or the IBR when the implied rate is not determinable. Estimating the IBR for your leases could be fairly involved. If you're a non-public entity, however, the standard gives you an option to elect the risk-free rate rather than using the incremental borrowing rate. Using the risk-free rate is no doubt much simpler and more straightforward. However, you need to understand the implications. The risk-free rate is typically very low and will result in a lease liability and right-of-use asset that is larger than those that would be calculated using the incremental borrowing rate. So what is an IBR? This discount rate should reflect 5 building blocks or components. First, the rate should take into account the creditworthiness of your company. Think of it as if you were financing the purchase of your asset. Second, it should take into account the term of the lease arrangement. The longer the lease term, presumably the higher the borrowing rate. Third, it should reflect the amount of the funds borrowed. The amount is reflected by the funds necessary to obtain an asset or of similar value. Fourth, it should consider the security or collateral that is granted to the lessor. A secured borrowing would in theory reduce your borrowing cost. And fifth, it should consider the economic environment, which includes the jurisdiction, currency, and date at which the lessee lease is entered into. The IBR is not simply the interest rate on an easily accessible line of credit or the weighted average rate that you pay on your other debt. It has to reflect all the components we just discussed. You can use the rate on your existing debt as a starting point, but you will need to adjust this rate to meet the definition of IBR. You could also estimate the IBR by looking at the borrowing rates of similar entities. You might research public debt markets to determine the borrowing rates for entities with credit risks similar to your company's. Again, under this approach, you would need to adjust the rate appropriately. For example, if the reference borrowing rate is associated with unsecured debt, then you will need to adjust the yield to reflect full collateralization. You could even ask your lenders to provide quotes of rates at which you could borrow, but again, you will need to make sure it's based on assumptions that will align with the definition of IBR. If you'd like additional insight on how to determine the discount rate, please click on the link below and download Blue & Company's ASC 842 Lessee Implementation Guide.